Hello, Strategic Alpha community members. We are yet here for yet another super interesting session with you all. And I have with us Mr. Jignesh Atos from Edelweiss Asset Management Company. And we are going to discuss about a post-IPO theme, which I think makes sense at current juncture to be investing into. So before going forward with this theme, I would like to discuss about why we got interested into this theme. So Jignesh, we were just discussing about post-IPO momentum in the post-IPO stocks whenever the bull market starts. And I feel the bull markets have started and the time has now come to look into post-IPO theme. So this is what I discussed with my community. And my observation was post-IPO stocks outperform all the indices in short to medium term, less than maybe 1 to 3 years. This is what I've seen. Like these are the stocks which became multi-baggers in those 6 month, 8 month, 10 month, or 1 year or a 2 year period during that time. Even if you look at the index, this is BSE IPO index. BSE IPO index has generated 100% return in around 1 to 1.5 years whenever the trend changed. So this has been my observation. And I was just contemplating whether the start of a new bull run in post-IPO stocks has started. Because if we see the past, during the each instance, in 1 year, 1.5 years, the index has given like 100% return. I'm talking about BSE IPO index. So during the last run, it gave around 100% returns for the investors. And once again, I feel that the time has just started for this team to play. And I was discussing with the community members that playing into post-IPO themes will be generating a alpha for the portfolio. And when I was discovering a lot of things, I discovered that Edelweiss already has a fund which is called as recent IPO fund. And we were fortunate that because it was earlier a lock-in fund, now it has got open. And that struck to my mind. And I connected with Prudent to connect with you to discuss on this topic. Let us discuss from the expert about the post-IPO theme. So over to you, Jignesh. So let me just introduce Jignesh once again. Jignesh Atos is a senior VP and zonal head, rest of West, Edelweiss Asset Management Company. So he looks after the business in this zone. Over to you, Jignesh.
So first of all, thank you, Suyog, for having me. I think it's a pleasure to connect with you this morning and discuss with you on IPO. I think as you rightly pointed out, that we have been running this IPO fund since February of 2018. And I think the clients who had come in kind of a roller coaster ride, because when we launched this fund, I think the timing was such where coincided with introduction of long-term capital gains. If you remember 2018 as a calendar year, I think large caps were up 3%, mid caps were down some 15-20%, small caps were down some 35%. So it was difficult task for us to convince an investor that why this is a good strategy, because one side your Nifty is looking up 3% and your portfolio is looking down 20-25%. It's so difficult to convince an investor. But I think investor had given us money for 3.5 years, as you rightly pointed out. It is a 3.5 year close-ended fund. And we handhelded them that, this is a good theme. I think this will play out very, very well. And when we opened this fund in August of 21 for repurchase, and we converted this into an open-ended fund, I think the client got the return of about 17% CAGR at the opening of the fund. So the client's experience was phenomenal, though they have gone through that roller coaster at the initial timing of the fund. So as you rightly highlighted, I'd like to show you that why we believe IPO markets will do well in times to come. So there are multiple reasons, but we believe of lately we have seen a lot of private sector capex which has been picking up humongously, and there is a pent-up capital demand for that. So I think there are companies which need capital for growth. At the same time, there have been companies who have picked capital from private equity investors at some time ago, and those private equity investors will look for exit at certain intervals. And that will also make compulsory for companies to come and list. And we know many such examples where promoters have come for listing just to give exit to the private equity investors because they wanted liquidity. Likewise, I think there is a subsidiary listing by conglomerates to unlock value. I think we are a classic example. Edelweiss itself is demerging all its subsidiaries, and there will be holdco company and there will be subsidiaries which will get listed over next couple of quarters. So that has been happening with a lot of large conglomerates as well. And there are PSU divestments. So this is where I think exactly we are placed, and we believe that there will be strong IPO pipeline in years to come for these particular reasons. Of course, there is a lot of capital supply, there is a strong GDP growth, and there is a stable and pro-business government. So all of these things are much more value-adding factor. But prima facie, these are the reasons which makes us believe that IPOs as a theme is going to do very, very well in times to come.
So, Jignesh, I would like to understand, you talked about IPO market and why it is going to flourish going forward. I would like to understand what are the challenges for a common investor to invest in IPOs?
So in fact, the rationale behind us launching this fund is exactly where a lot of investors were coming with us and sharing their experience in terms of IPO investing. And we realized that a lot of times when investors make money in good IPOs, they exit very, very early. And a lot of times when there are not so great companies which they have bought into IPO, they are sitting on huge losses and they hold on losses for a very, very long time. On an average, it's a very hyped. I mean, investors like to trade into IPOs. But when we see average returns these clients make over many years, let's say 4 or 5 years over overall IPO average returns, I think that were not looking very, very attractive. And hence we felt that there was a need for a professional team to come and address these issues. I mean, prima facie, we believe there are a couple of solutions which we provide through this recently listed IPO fund. The first and foremost is access, because today we all know that retail application sizes are restricted to about 2 lakh rupees application by SEBI. But the moment you go above 2 lakh rupees, if you look at the kind of allocation in either HNI category, I think it is very difficult to get access to a lot of good quality IPOs. So when the IPO quality is good, when you are liking to subscribe to those IPOs, you will hardly get allocation. Second, once the allocation part is taken care of, the also very important part is selection, because not every company makes money. I mean, there are good IPOs and there are not so great IPOs. So I think we also dwell in with our expertise to have better selection on this IPO that are coming for listing. And our focus is also on post-listing gains, because listing day gains is limited, but there are also opportunities on the post-listing gains. So these are the three challenges which clients face at their end, and that is where Edelweiss IPO comes into picture and help the client resolve these issues.
Just to get a clarity, you're talking about more on IPOs. I would like to understand whether it is a post-listing recent IPO theme, or you also invest into ongoing IPOs which might come for listing.
Yes, I think we look at both. We don't, the moment a company files DRHP and they come up for listing, right from anchor levels, we are qualified as QIB, so qualified institutional buyer. Plus, we also can participate into anchor book when it comes to IPO allocation. So we can buy only once IPO filing is done and the company is coming up for listing. At the same time, it is not that we are only buying into this company for a listing day gains. We will, like, let's say, for example, there are companies where the prospects for next 3, 4, 5 years are even better. And we believe the value unlock has not happened at the time of IPO listing. Probably we'll buy more once the IPO listing happens, because you get, any amount of shares that you want to buy from open market. So in that sense, we will use that strategy. But yes, post-listing gains is also equally important. If you see our fund's performance over last, from the inception, the fund has delivered some 14% CAGR return. And there are only 1.5% return, which is coming purely from the listing day gains. The remaining returns are coming more from the post-listing gains. And it's important. See, you can have an example like Avenue Supermarts, which is a company which operates DMart. I think it was a 300 rupees IPO which got listed at 600 rupees. I mean, for a lot of investors, 100% return were very, very attractive. And they might feel that, okay, 100% listing day gains, I'll exit. So at 600, a lot of investors would have exit. A fund like ours will be buying more at 600 rupees. You see what kind of value unlocking it has happened over the last 4 or 5 years. So it has gone 5-6x from the listing day levels as well. So this is what I mean by post-listing gains. So we evaluate each company, whether if there is a potential to deliver on growth in times to come, then we will want to hold on these companies for post-listing day gains. In terms of access, just to elaborate, how we resolve these challenges. I think, as I mentioned, that access, selection, and post-listing gains. I think access, as I was highlighting, that retail is definitely, I mean, it's little lucrative when it comes to allocation. But problem is that retail is classified only as less than 2 lakh rupees application. So the moment client fills in application of more than 2 lakh rupees, you qualify as HNI. In HNI, you see the companies which have given maximum returns, and you can see that into the last row, that more than 50% returns on the listing day gains. Those companies are, subscribed for more than 300 times in HNI category. Now, you just imagine that any company which is getting subscribed by more than 300 times, what is the kind of allocation an individual will get? Plus, there is a lottery system which this company uses. Participate in this IPO allocation through QIB route. I think we have relatively more better allocation as compared to HNI segment. So that is the first place where this fund comes and addresses the issue. The fund also, allowed to use the anchor route, but anchor is subject to promoter discretion. We do have a lot of great relationship with a lot of large management companies where we also have participated in the past in portfolio companies through anchor route. But it is not, in our hands. We'll try our best to get anchor allocation in good companies. If not, fund anyways classifies as QIB wire. Second point that I was mentioning, that you will have all sort of companies. I mean, companies which will do very well, companies which will not do very well. So selection is also very, very important criteria, because for every 5 great companies, there are 7 to 10 not so great companies. So there are wealth creators in IPO segment, and there are wealth destroyers in IPO segment. So we believe selection is very, very key. If you excel in selection of which companies to buy in and which companies you should give it as a miss, I think that can also enhance your portfolio returns very handsomely. And this is precisely what we have been doing for last 5 years. That if you compare our performance with the underlying index, which is recently listed, Nifty, NSE recently listed Total Return Index, I think the fund has outperformed consistently its benchmark at all points of time. Not only that, even if you look at an additional index like a BSE IPO index, as you were mentioning, I think since inception we have outperformed BSE IPO index as well. So I think that is only possible when you go with good selection. We have given base to IPOs like Paytm. We have given base to IPOs like LIC. I think we had our own rationale of why we will not like to buy those companies during IPO. But a lot of times we have been proven right on this mechanism. And I think that helps in terms of enhancing your portfolio alpha or portfolio returns.
So anything which you want to add?
The last I was mentioning about post-listing day gains that we discussed already, that the way we look at post-listing day gains is we evaluate each company on what the moat is, what the growth potential is over next 3, 4, 5 years. And if there's a merit on holding on, we will rather hold on those companies for better returns. In fact, we'll add more if we felt that there is a potential. We'll add more. We also have episodes like companies where we have not subscribed into a lot of names during IPO, but once we have seen some bit of correction on IPO price, they being available at 20-25% cheaper levels, I think we have bought into those names. So it is very, very selective way in which we approach. Important is that if you look at a lot of these names, there are total 180 companies which qualified as a universe for our fund from its inception. Till date, we have bought into only 65-70 companies. So 2/3 names we have given it a miss, and we have been very, very focused on what kind of companies that we want in this portfolio. So it's a growth portfolio, and we will want to reflect that on the portfolio as well as its returns.
Great. So you have very nicely explained how do you overcome the challenges in investing.
Yes.
Your stocks. And how do you even increase post IPO whenever you think that there might be a great opportunity? I would like to just understand what type of fund is this. Means investors might see that there is diversified firm, or whether it is a sector fund, or whether it is a thematic fund.
So this is definitely, I mean, if you ask me as a category, this will definitely fall under thematic fund category, because our universe is restricted. 80% of our investments or portfolio investments have to be into last recently listed 100 IPOs. which means if the IPO cycle is slow, on an average, we have seen about 20, 25 IPOs hitting the markets every year on an average. So in that case, my universe will be there till 4 years, and you will see that universe being upgraded. So in that sense, there is a theme attached to it, and it will qualify as a thematic fund. But also, I like to put caution here is that this fund is not meant for someone's core portfolio. I think your core portfolio should be filled with funds like Balance Advantage Fund or Flexi Cap Fund or large and mid cap fund, or maybe even mid and small cap funds, right? So you will, and everyone's preference that how much allocation you want in core portfolio. Someone will be okay with 50, someone will be okay with 70. But everyone wants that kicker returns, and there a lot of people look for some kind of a satellite allocation strategies, and we believe that this fund fits more perfectly in that satellite allocation strategy. And at a portfolio level, if someone can have exposure of anywhere between 2 to 10% into a fund like this, I think this can definitely deliver kicker returns when the theme works. So this is more of a satellite portfolio allocation strategy rather than core, is what I like to caution. And the reason why I'm also mentioning is that because there is a lot of cyclicality attached with it. And we have seen at the start of the fund launch that first year has not been so great, but I mean 3.5 year experience have been very, very great. Again, any client who has come into the fund for last 1.5 years has very muted performance. But we believe that these are the phases that we have seen in the past also, and they will keep on happening in the future also. But when it covers up, it will, on any 3 year, 4 year rolling returns, I think the fund will cover up very, very beautifully. That is how the fund is positioned.
So you rightly pointed out that this shouldn't be a part of the core portfolio. And even in my community, we have discussed, when I was discussing the post-IPO strategy, we were talking more on satellite portion, and this fund perfectly fits in there.
Okay.
I would also like to understand, and because this is a thematic fund, there has been good cycles and bad cycle. I would just like to understand what has been the performance of this fund and the stock during the upcycle whenever it started in past, because this has a long, I think, 5 years of history. I would like to understand that both bad and good cycles so that investors can understand. Because I personally feel that we are at a current juncture where the upcycle has started, and that is why I've invited you to discuss this fund.
Definitely. So let me share data on those lines as well. So let's look at returns, that when theme works, what is the kind of returns which gets generated. So this is as of 31st May. I think from the inception of 22nd February 2018, when we had launched this fund has delivered about 12% return. And this is, if you compare with Nifty 500 total return index, which primarily becomes the benchmark for the fund, because it has all large, mid and small cap stocks. And it is one of the toughest benchmark to beat as well. So it is in line with those returns. But when it works, I think we have seen last 1.5 years has been more muted for this IPO stocks. If you just go back about 1.5 years and see the performance of this fund was delivering about 10% alpha as compared to Nifty 500, TRI. Now, when the theme will not work, you will still deliver index-linked returns, which is either a Nifty 500 or, let's say, midcap has delivered 9% returns from 22nd February 2018 till date. This fund is outperforming midcap by about 3%. Small caps have delivered about 11.38% return. This fund is outperforming small cap index as well. So we believe that if you look at the fund like this, and we are talking at a junction where the theme has not worked in last 1.5 years, despite that, it is taking up really very well in performance. When the theme will work, and because it's little cyclical, when the theme will work, I think it has a potential to generate a huge alpha as compared to other categories. So that's how the performance stack up. You can see for a lot of years, like, theme didn't work in 18, but when you see 19, 20, 21, I think the theme for those 3 years have worked beautifully. And this is, just look at 2019. I think when midcaps were down about 20% in calendar year 2018, this fund was positive about 147. When midcaps were down about 726, this fund was up about 9%. So it has an inherent, and while the fund also invests into midcap, so 2/3 of the portfolio is mid and small cap. About, as we speak, rather 70-80% of our allocation goes towards mid and small cap, and hence I'm comparing to those indices that despite that, I think the fund had stacked up beautifully as compared to those indices. So when it comes to potential of delivering alpha, I think when the theme works, it will surprise you on the positive side. It may also taste your patience at a times like this when the markets have been doing fairly okay, but this theme has not caught up. So it may also taste your patience at times, but with long-term investors, when you look at this strategy with a 3 to 4 year horizon, I think this category has potential to deliver those quicker returns at the portfolio level.
So I would like to understand what is the composition of the fund in terms of market cap.
So as we speak, in fact, when we started, this was about 60% mid and small cap and 40% large cap. Of late, what we have seen is the more and more companies for IPOs have come up from mid and small cap. And how I define mid cap, small cap, and large cap is any company which has more than 25,000 crores of market will classify as large cap. Any company which is having more market cap than 10,000 crores will classify as mid cap, and any company which is less than 10,000 crores market cap will be small cap. By this definition, if we see currently about 80% of the portfolio, about 77 to 80% of the portfolio is between small and mid caps, and about 20% of the portfolio will be towards large cap companies. So that is how the market cap breakup is stacked up.
Can you explain how the fund is constructed?
So the way we construct this fund is, as I mentioned, that minimum 80% exposure has to be into a last recently listed 100 IPOs. What we aim to do is we look at 30 to 40 ideas across sectors, as I mentioned, with a market cap bias towards mid and small caps. Now, sizing of bet is very, very important. It will be based on our conviction. If we are very convinced on certain companies' prospects, then probably we will size the bet relatively higher to its benchmark weight. If we are not very convinced, but we believe that a stock has a potential to deliver decent capture, then we might size it appropriately. And if we are not at all convinced, then we'll completely give it a miss. So the sizing of bet is more of a function of what our conviction lies in through that particular business, and what the moat of that business is. The way we will do restructuring is there will be a periodic balancing also with regards to fundamentals and business prospects. But a very important point which I'd like to mention here, Suyog, is that if you look at US, this new age companies, or maybe let's say tech companies, are 25% of their overall stock market cap. If you look at India, we are just at about 1%. These new age businesses or tech companies, which are more coming through IPO route to India, or so-called growth companies, are just 1% of our total market cap. So we believe there is a humongous scope for these companies, and I think as what West has shown over a period of time, we are moving towards that direction where percentage allocation in the overall market cap is of the overall stock market. These companies are more disruptors. These companies are more growth companies, and hence allocation of these companies in overall market cap is just going to grow from here in next 5-10 years. In terms of process, what is the process that we have in terms of picking up this company? So we do a very deep dive, financial analysis in all of this segment. Once the company files DRHP, we go through DRHP, we look for sectoral analysis also. Once we are convinced about the company's growth potential, we look at qualitative analysis, that how's competition landscape stacking up, how this company is different, how have they used their funds that they have raised in the past, how prudently they have used that, and what is the management quality. I think each of these we cover it under qualitative analysis. As we discussed, that we size the exposure as to our conviction, and we also keep a very tight risk management systems on the portfolio. We also have the upper side of 35% as sector limit. This being thematic fund, the sector limit is at 35%. We keep a very tight eye on liquidity, because if the portfolio is more tilted towards mid and small cap, though we restrict ourselves to going towards micro cap, but we still keep a very tight watch on liquidity. And there are some internal stock limits that we keep for each business and each company. So it's a very detailed process driven approach that we have in terms of mitigating risk per se when we pick up the portfolio companies. So that is how we do the portfolio selection.
I would like to understand, most of the IPOs usually don't come at juicy valuations. Not much value is left on the table.
Okay.
Understand your view on that, about the valuations of the companies which are coming for the IPO, or even after the IPO when you spot on the opportunities.
Correct. So I think it's a brilliant question, Suyog, and I think you are very right that a lot of these when they come up, a lot of promoters will come up at the time where the company is at peak of their growth potential. But having said so, there are many companies which also come up for to market for listing for other purposes, for value unlocking, as we spoke about, for a lot of large conglomerates which are listed. They come up with subsidiary demerger or subsidiary listing. As we spoke about, a lot of these angel investors who have done the funding, and the company has grown to an extent where they need liquidity. No matter what, are forced to go for IPO route to provide exit to those investors. So we believe there are some real good companies which are coming up for listing for this purpose as well. So precisely, I mean, we have seen some examples where companies come up with rich valuations, and as we always say that it is the price you pay which will decide your how much returns that you will make from that opportunity. So if you believe that it is fully priced, there is nothing left on table for investors, then probably we'll be fine giving it a miss. And any which ways, our universe is 100 companies, and all we want is 25, 30, 35 good companies. I think we have enough scope of giving miss to a lot of these kind of companies which comes for value unlocking at peak of their growth potential. But interesting part is that there are many other kind of companies which come to listing for other purposes, as we discussed ahead, and hence those provides opportunity to buy in and make create wealth for our investors. And we have tons of examples of what kind of wealth creation that has happened through the recently listed IPO stocks in last 5-7 years.
Can you just share a few examples on that?
So the couple of examples is as we spoke about, company like Sona Precision Camshaft that had come up for listing. We have seen Amber. We have seen Avenue Supermart. In fact, that qualified as part of our portfolio also, and the kind of value unlocking that has happened for a lot of investors is very, very phenomenal. You look for companies like and see, I'll also touch upon this that typically when you look at any segment, you will see like banking and finance. Traditionally, banking and finance has been more, banks and NBFCs. But if you look at off late companies, those have come up for listing. CDSL, which has come up for listing. You have EMCs, you have SBI cards, you have insurance companies. So we believe that within financial services, these are the companies which are having much higher growth as compared to traditional bank and NBFC growth that they are delivering. And if you buy these companies any which ways, your growth potential is higher as compared to traditional sector. Likewise, you look at, we saw IRCTC, which is more, we call it classified under technology because though it is a railways, Indian Railways company subsidiary, but if you look at it falls under IT services because it is a platform which enables, much much ease to basically clients in terms of travel or planning their travel. So we believe that there are companies that in the IT segment you were having more IT services company erstwhile. But if you look off late, we have companies like Nazara, Eiffel, Happy Minds, IRCTC. All of these companies are coming up into IT servicing. So there is a digital, internet, gaming, analytics. All of these segments are getting covered into new age businesses. So each of these segment, when you see, I think there has been a shift in terms of the disruptor taking over the market share from a lot of existing companies. And in that case, we believe that new age businesses, there have been a lot of potential. Of course, there will be failures also, and you have to be very, very mindful of where you are putting your money in. But if you have potential to select right companies, and we personally believe that as an organization, we have that edge because as a group, we have looked at IPOs for a very, very long time. And the kind of insights that we have for a lot of these companies or the sectors or the promoter group or management, I think that enables us to take a very, very much more calculative decisions on which companies to back and which companies to avoid. So that is what I meant by it.
So will you always also invest in SME opportunities in this fund?
Highly unlikely because the mandate is very, very clear. We have a threshold that less than 1,000 crore company is we will not look for into this IPO fund. The rationale is also because this is an open-ended fund that we are running. And a lot of times when you go into micro caps or SMEs, I think liquidity is a big issue. So we believe it's a mismatch for our investors if we are going very into the SME segment or micro caps. Hence, we have restricted ourselves that less than 1,000 crores market cap company we will not want to get into.
So will the fund will also be investing into pre-IPO stage?
Not really, because see, pre-IPO is a different segment altogether, and we are on to the mutual fund platform, and we believe that we don't want to get into a pre-IPO kind of stuff. But when pre-IPO will exit is probably when IPO investor will kick in. So as an a public sector organization, we want to just focus on companies which comes up for listing, because pre-IPO also is a lot of times illiquidity is the angle which comes in. While because we run an open-ended fund, it doesn't really match with our threshold. So hence we will always be focused on IPO companies. Only once IPO listing is happening is where our fund will get into, not before that.
Perfect. So I would like to understand what is the winner to loser ratio of the fund manager on overall calls taken
Sure.
till.
So I think the other way to look at this winner to loser ratio is when you win, how much you win. When you lose, how much you lose. So in that sense, if you look at our portfolio, we have seen the contributor to detractor ratio. When some company contributes, that contribution is creating alpha of 8, 10, 12% as compared to the traditional benchmark returns. When we don't make money, when we lose out money on some of the stocks, we have seen that our losses are not as humongous as our contributors. So our losses are more curtailed towards 2, 3, 4%, and we just rejig those portfolio if the math that with the basic premise that we have bought into the stock is not working, we will immediately curtail that. So in that sense, our winner to loser ratio is very high. I'll probably say that almost 2/3 of our portfolio that we have buying into, because we do a lot of research before we get into stocks. And we just track and keep updating ourselves once we have made the investment decision. So because a lot of insight is much prior to the investments, I think it is helping us with higher winner ratio than on the losing side.
Okay. So what would be that number if I'd like to ask?
So that would be about I will say about 2.5 is to 0.5.
Okay.
Not even 2 is to 1, because it's more about 2.5 to 0.5, because I think it's winning, losing is a very a diplomatic word. I'll rather say that sometimes, let's say, I'll still win on 80% of my bets. Maybe the return generated would be very different. In a particular company, I'll make, let's say, 10, 12, 15% alpha. In another company, I'll make 2, 4% alpha. But both are winners for me. While versus, if you look at losers is where we are not making money from our original investment date. So those companies are very, very limited. I think if you ask me, from about 55 companies, there will be only 4 or 5 names where we would have not made money. In that sense, it will be like about 9 is to 1 kind of a ratio that will kick in.
Okay. Anything apart from my questions?
Yeah.
Anything which you want to share to the audience?
Absolutely, Suyog. I think I'll just share. You also started this call by sharing that why this IPO looks good from this particular junction, and I'll just like to support that from here on. That I think couple of rationales. One, if you look at whenever there is a big hike on interest rates by central Fed or whether our central banks here in India, I think we have seen that whenever there are steep hikes, the growth companies are impacted, because on discounted cash flow model, what happens is your earnings are much more prolonged, while you take an immediate hit in terms of your cost of funds. And hence the valuation math, or the I'll rather say earnings math, which has been given, the sentiments take a big hit around these times. But what we have also seen is that as we have seen, there is a huge rate hike both in US as in India. In India also, I think we have gone up 250 basis point in terms of interest rates. In US, I think we have gone about 350, 400 basis point up on interest rates. So in this scenario, I think the theme has not worked in last 1.5 years. But as we stabilize, we believe that now is the time where, as we stabilize and as we maybe over the next two-year period, RBI will start cutting rates. I think it will become much more friendlier for this IPO companies, because the growth will come back in focus. I think what has also happened in hindsight, Suyog, is that this rate hike, erstwhile what has happened is there was so much of easy liquidity in the system that all of these companies were getting liquidity very, very easily. And hence the focus was always on the top line, on revenue growth. No one was worried about, bottom line or the profit growth. Good part is that this has nudged them, this rate scenario, the funding winters which has started. This has nudged a lot of these companies, and we are just analyzing the quarterly calls, result calls of these companies. I think all of the companies, their focus is only on profitability. So that is a great nudge for portfolio like ours, because we will see them becoming more profitable in advance, and then probably they will again relook at a growth picture. So that is one great thing which has happened. And third, I'll say that valuation wise, we are having a very good valuation at this point of time. I think about 1.5 years ago, there was a lot of froth in terms of valuation for a lot of these companies. I mean, there were crazy, I will say, earnings which were being attributed to them, and basis that the valuations have been given to them in a crazy avatars. I think those have kind of there is a tepid offset on those lines, and in that sense, we believe that earnings are kind of catching up, and valuations have taken almost 40-50% hit. So we are very comfortable with this valuation, that any client who comes in today is coming up at a much better valuation, and with a 3 to 4 year horizon, I think the potential of making good returns from this strategy like this for the satellite portfolio allocation will be very, very helpful, is how I'll sum up this IPO fund discussion.
So you have nicely pointed out all the things. So for the investors, I would like to just conclude on today's discussion on Edelweiss recently listed IPO fund, that I believe that we are at a current juncture where the upcycle has started. And as Jignesh has explained all the things, like the valuations are in comfortable zone. More and more we are into the bull market now. Apart from that, the money will start flowing in the new age companies, and all these themes can be well played through recently listed IPO fund from Edelweiss. And for an investor coming with a horizon of around 3 years or plus, he has a great advantage at this juncture when the valuations are in favor and the IPO markets are might open up, which can generate significant alpha for the portfolio. One word which he has told with caution is Edelweiss recently listed IPO fund should not be a part of the core portfolio. It should be played as a satellite portfolio part, wherein an investor can go up to 10% of his portfolio in this fund. So with this, Jignesh, I think you have covered all those points, and I have concluded all those things. I thank you for giving this insightful presentation to all the audience here. And thank you, Jignesh.
Thank you so much, Suyog. I think it's pleasure talking to you as, discussing the IPO fund. So thank you for the opportunity.
Thank you, Jignesh.